Okay, so welcome to your final webinar of this class. We are getting to the end of the class, and I am going to go over chapters 11 and 12 tonight, as well as kind of talk about your final and your last 2 weeks. As you know, I am leaving tomorrow for a much-needed Caribbean cruise. And I will be out of pocket next week for most of the week. Now, with that said, I want to make you aware of what I'm going to do. So, on Tuesday, we will be in St. Thomas, which means that's a U.S. country, and I will have access to email on my phone. So, if you need something answered, if you are confused or whatever else about one of the problems in Chapter 11, or the problem in Chapter 11, then you need to send me an email and ask me what your question is by the time I get there on Tuesday, and make sure that it's complete, because you're probably only going to get one chance at this. When we get off the boat, I can, as long as I get away from the pier in the dock, I can answer email. So I will have access to that, and I will answer email and turn my phone on at that point. I will also have my laptop. So there's a good chance that even while we're on the ship, I might purchase a small internet package and have access to email and stuff there. But just keep in mind, I won't have a lot of time to go back and forth and respond and things like that. So Tuesday, we will be in a U.S. territory. Get me your questions before then. The next time that we're in a U.S. territory is when we hit Puerto Rico on Thursday. So if you have a question that doesn't get to me before Tuesday when I'm off the ship, so that's going to be from like 8 to 5. I have to be back on board by 5. Okay, and there's a chance we might be back on board by 3 or 4. I don't know. So at any rate, if you can get me your question, obviously I don't want to spend all my time in St. Thomas answering questions, but I will get off and answer questions as I can and stuff like that. Thursday, Puerto Rico, you can ask me questions then. And then we will be back in the U.S. and off the ship on Sunday, and probably sitting in an airport. So if you have questions about Chapter 12 or the final, I would ask me on that following Sunday, May the 3rd. Okay? And I will be home on Sunday, so you can call or do whatever you need to. As far as the homework goes, keep in mind, Module 7 next week is due on Wednesday, okay? But on Module 8, which is due the following Monday, Module 8 week is a short week. That's finals week, okay? And the class, as well as everything about the class, ends on Thursday, okay? So the quiz and the final are due Thursday of week 8. Okay? So I believe that's the 7th. Let me look and make sure. Yes, that's the 7th. So everything is due for Module 8 by Thursday, May 7th. Please, please, please do not forget that. I cannot accept anything past May 7th under any circumstances. Okay? So don't wait till the last minute to do your final and turn it in. Plan your time well. The final is available to you right now. It is open. Module 7 and 8 are both open. Everything is available to you at this moment with the exception of the homework answers. And those will become available at the time that it says they're scheduled to. Okay? but Module 7 and 8 quiz and Module 8's final exam is available to you right now. So you can go in there and you can actually download it, start looking at it, comparing, learning, doing what you need to do. Okay? So make sure you don't wait till the last minute. This is on you guys. Okay? I can't help you if you turn things in after the 7th. Alright? Let's see. What else do we need to talk about? So Module 10 or Module 6, sorry, let's go back a chapter. Chapter 10. So that problem got a lot of people. It was pretty hard, pretty complex. Make sure you go in and you look at the answers. I know one of the questions was on the borrowings. How do you get the borrowings? And that was simply taking the 22,000, negative 22,000, and saying I also need 3,000 in cash to start the month, and you add those two together, and that gave you the 25,000. And then same thing with the next month. It said you had negative 2,000 left, and you need that 3,000 to start June, so you have to add those two together, and that gave you your 5,000. So that's where the 25 and the 5,000 came from. That's the 30,000. Okay. Let's see. So I think that was the biggest question that I got out of that stuff. Chapter 11 is going to be very similar. I am actually not going to go through and go down through the chapter like I usually do. We're going to go straight to the problems tonight because I've got to get through Chapter 11 and Chapter 12, in addition to getting you 2 study guides for the quizzes for Chapter 11 and Chapter 12, and getting ready to leave for my trip tomorrow. So, got a lot to do. It's been a busy week. I am trying to get all your stuff graded too before I leave, so keep in mind next week when you turn in your homework and stuff, I won't be able to grade it until I get back. I'll probably try to grade it on Sunday while I'm sitting in the airport waiting for the plane. Or maybe even in the air. We'll see. And Jeanette says, just cut out the quiz. Help you and us. No, actually the quiz is auto-graded, so that's not going to work. But anyway, so just really make sure that you understand these last 2 chapters. Chapter 12 isn't going to be too bad. It's mostly time, value, and money stuff that you're going to be doing, and it's pretty easy. So, but Chapter 11 is another very long problem. It's not that it's hard, it's just long. So, we're going to get started, and we're going to go ahead and go through it. All right, so any questions right now? Jeanette, am I missing anything that I needed to tell him? Okay, good. All right, so let's see. So Chapter 11 is basically about segment reporting, transfer pricing, and balanced scorecard. You can go down and read through what all of that is. The segment reporting is much like saying, you know, we've got this segment and that segment, and then we've got the total company, which is basically what your problem is going to be in this chapter as well. Transfer pricing, balanced scorecard. Transfer pricing is the internal value assigned a product or service that one division provides to another. Okay, so that's just, this chapter is basically dealing with large companies that have multiple divisions or multiple subsidiaries or what have you. So like multi-book accounting is what it would likely be referred to. So it's just, you know, kind of how do you deal with that, okay? Balanced scorecard is basically just trying to determine, you know, how you look at and measure the company, right? So let's see. So basically, it's a performance measurement. Okay, it takes a look at the financial, the customer satisfaction, the internal processes and innovation and learning. Okay, maybe some other things as well. So this is like having something on your dashboard, on a dashboard screen that tells you, hey, my company's financial, stability or financial performance looks like this. My customer success measurements, like my satisfaction is showing that my customers are 95% satisfied with my product or whatever. So there's just all kinds of things that would go on like a dashboard that look like that. And that's actually something that I build in the systems that I build for companies. So it's a very popular topic these days because it gives management something to look at and say, as of this day, and a lot of it has gone to being in real time. As of right now, my company is performing or tracking like this. So that's kind of what the balanced scorecard is all about. This is what it looks like. So interesting. Kind of looks like Burst, which is one of the systems I build. So ours is a little more complex, but a lot of systems you can literally, like if you just wanted to know what you did in the United States, for instance, you can drag over the top of this and it will tell you exactly what the United States was doing, in terms of whatever this is. This is sales distribution. So, that it's kind of what it looks like. And then you can see here, it shows you like your performance trend on expenses, your margin, your revenue, things like that. So that's what a scorecard looks like. Okay, it's a good example. So, all right, let's take a look at this problem. So 1133, segment reporting and analysis. Okay. So it gives you all of this information, right? And you need to read through it so you understand where it comes from. And you'll see here you've got two different areas. Okay, you've got Minneapolis and you've got St. Paul. And then you've got the total company, right? So this is actually literally how you're going to set that up. Oh, one thing that I am going to do for you guys this week. I am going to go through and I'm going to set up to try to help you set up each one of these problems, and all you're going to have to do is fill in the numbers. Okay? So this Excel document is going to sit out in Module 7. Okay? I will probably open up another Excel document and do the same thing for Module 8. That way, I'm hoping that A helps you determine what it is you need to put together and learn the structure, okay? But it will also give you a format for your final exam, okay? And hopefully eliminate some questions, or confusion that you might have along the way. So, rather than me just doing this and then canceling it out after I get done with the webinar, I'm going to save it and I'm going to upload it to Module 7. Okay? So you will have your very own template. Alright, so A asks you to prepare a segment income statement showing the territory margin for each sales territory for March. Include a column for the entire firm. Now, nice thing about that, the entire firm or the entire company, however they want to word this, is just totaling up what already exists. Okay? Alright, so let's do this. So we're going to say, of course I can't copy this. Alright. So, sales, we've got variable expenses, and then we're going to break these down. Okay, so in this variable expenses section, you're going to have baking, which I'm going to put a little asterisk by. You're going to have selling. Okay, put 2 of them by that. Alright, so those are calculations that we're going to make down below this. Okay, so just to bear with me, I'm going to set this up. Contribution margin, then direct fixed selling expenses, territory margin, fixed expenses, and this is going to be broken out as well. Baking, administrative, and total. And you're going to have your net income. Alright, so here's our initial, this is what we've got to put in our income statement, okay? And then we are going to come down here right below this, and we're going to calculate our variable baking expenses for Minneapolis, and one for St. Paul. Okay, and we're going to talk about the donuts, the bread, pastries, and we're going to total. Okay, so this is going to apply for both of these. Okay, for both Minneapolis and St. Paul. Alright, then we're going to do the same thing, only with variable selling expenses. Okay, and it's literally going to be a copy of this. Okay, only the selling expenses. Alright, and then we have one more thing to calculate in the common fixed baking expenses. This is going to be you have to get that as well. So I'll show you how to do that in a minute. Alright, so let's start at the top. Right? So our sales, it tells us for Minneapolis is $2,100, for St. Paul is $500. All you got to do is put those two in place. Right? And then the sum is going to be that plus that. Right? So that's the company total. You're not going to have anything in this line because this is more like a placeholder line for just, that label. Right? So we've got to come down and we've got to calculate our baking expenses and our selling expenses for this next part. Okay? So with that said, we're going to take a look down here and do our baking expenses first for Minneapolis. Alright? So our variable baking expenses for Minneapolis for donuts. Okay? Here are your products. This is your sales and selected variable expenses right here. Okay? So for the city of Minneapolis, we see sales are $850. Okay? But we have variable baking expenses as a percentage of sales. So this is very much like what we did in the last chapter. All right? You got to take that 850 and multiply it by the 50%. Right? So this is going to be equal sign 850 times 0.5. And that's going to give us our donuts, right? Same thing applies for St. Paul. Okay, you're going to have your donuts that are, for St. Paul sales, $200, and it's 50%, right? So you would do equal sign 200 times 0.5. Okay? So that's how you're going to get these variable baking expenses. You're going to go through and you're going to pick that stuff out. Here's your bread, here's your pastries. Here's your percentages for each one of those. So that goes up here. I'm not going to fill in any more. You have to get those. Your total is just going to be a sum of those three. Okay? So that's all you have to do with that. All right? And then you take this number right here and you're going to put it in the appropriate baking variable expenses. Okay? So this is going to be equal sign whatever that number is. And this is going to be equal sign whatever this number turns out to be. Okay? That's all there is to it. Selling is the same thing. So you're going to come over here and you're going to talk about the variable selling expenses for each of these locations. And again, that's right down here. So variable selling expenses as a percentage of sales. You've got 4%, 4%, 6%. So you go here, you pick out which one you have to do, and you figure it out. Okay? So for instance, donuts. Minneapolis is 850 times 4%, right? So that's going to be 0.04, and it gives you your calculation, okay? Total is, again, just a sum. So this isn't hard, it's just time-consuming, right? And then you're going to link this total right here. So equal sign, and click on that, and it links it. So that when this changes, this will change. Okay? Same thing with this. Equal sign, link it. Okay? Alright, so then you've got your contribution margin. Now, what you're going to do is, because these are expenses, remember, these are expenses, you're going to take whatever the negative sum of these two are. Okay? Same thing for this. Equal sign negative sum for these two. Okay? And then that's going to give you your total here. So you're just going to sum those two, or just add these two numbers together. This plus this. Okay? It's going to give you a negative. So your contribution margin is going to then be the difference of those two. So you can equal sign plus this and this, and there's your Minneapolis contribution margin. Equal sign this plus this, there's your St. Paul one. And your company total is going to be this plus this. And there's your company one. Okay? Or you can add those two together. It doesn't matter which way you do it. Alright? Then you've got to figure out your direct selling expenses. Okay? So, you're going to put in your direct selling expenses here. Okay? So, let's see. Where does it tell you? it's telling you down here the fixed selling expenses were $385 for March, of which $160 were direct expense of Minneapolis market and $225 of St. Paul. Okay? So there's your direct selling expenses. You put those right there. All right? And those are also going to be negative. So like this one will be 160, and this one will be negative 225. Okay? And then you've got the total. Okay? Your territory margin then is going to be whatever these two add up to be. And keep in mind, these numbers aren't complete, so these are not the right numbers. You've got to go down and calculate the rest of the stuff at the bottom. Make sure you get everything up in there to be correct. Okay? So we're going to do this plus this. Or you can also do it this way, equal sign this plus this. And that's going to give it to you. All right, common fixed expenses is just a placeholder. We don't have anything in that row. So here's baking. All right, so these are common fixed expenses. Now, this is going to go on the company as a whole. You're not going to have anything from Minneapolis and St. Paul. This is going to be on the company, okay? So keep that in mind. Remember that. All right, so the way we're going to calculate this baking expense is by adding some numbers together, some of the common fixed expenses that are listed up here, okay? So for that, we have we're going to have, let's see, so you've got 400, no, that's selling in a minute straight up. Where are we looking for this? Which management has decided not to allocate when using the contribution approach. Okay. Alright, so if that is the case, fixed baking expenses right here. Okay? So you're going to take those expenses right there and add them up. So basically what that's going to amount to is equal sign 200 plus 140 plus 100. Gives you 440. So then you just take and link that number, right? Your administrative is 130. Okay, so again, when they say stuff like management has decided not to allocate when using contribution approach, so they're basically saying that they don't want to break that $130 out to these two locations. Okay, so you just put 130 there, right? And then you get your total. So this is going to, again, be a negative because we're adding up two expense categories. Okay, so you have to take this off of your margin. So negative sum of these two. Okay, and then you take and you get your territory margin plus your total common fixed expenses, and that's going to give you your net income. So that's the first part. Not terribly complicated. You just have to walk through it and get your numbers, right? Anybody have any questions? Okay. All right, so B. is going to be just a little bit different. Get this. So, in B, it is asking us to prepare a segment income statement showing the product margin for each product. Include a column for the entire firm. So, let's go back to our Excel sheet. We are going to have sales, and we're going to break those out by location. So you're going to have Minneapolis, and St. Paul, and you're going to have a total. Okay? Then again, you're going to have variable expenses, and we're going to do baking, selling, cool. And contribution margin, fixed baking expenses, product margin, and common fixed expenses, selling, and then you're going to have your net income. So this is basically just taking a look at the product and company income statement in a different manner. Okay? So this isn't anything to panic about. This is just a different way to look at it. You're basically going to come in here and plug numbers. Okay? So your sales of donuts for Minneapolis. It's $850. Your bread was $900. I'm getting all of this right here. Okay? Your pastries, $350. For St. Paul, same thing. You got $200. All of it from right here. $150. $150. Your total is going to be a sum of those two. Right, and then you're also going to sum your company total. It's just that easy. Right? So your variable expenses then for baking, you're going to come back and take a look at those. So for your variable expenses, baking donuts, right, you're going to have 50%, yep, 50%, 50%, and 60%. So you're going to take that here. So you're going to do this times 0.5, this times 0.5, and this times 0.6. Right? Again, you've got a sum. Right? And then you're selling, you do the same thing only with the selling percentages. So these right here. Okay? Letting you do those. Then you're going to total, and you get your contribution margin. Right? So your total on this, you need to make sure Anytime, remember, anytime you're doing an expense, it needs to be a negative. So you can do a negative sum and get your negative, okay? Right? And then your contribution margin is going to be this plus, oops, hit enter instead of plus, this, all right? Okay. Fixed baking expenses, this again is right here. Okay, so you plug that in and you're going to subtract that out as well. So you're going to just take this number plus that number. So this will be a negative, right? So like for instance, this is a negative 200 and you're going to do a plus of these two. And that's going to give you your product margin. That's a place. And your selling is, these again are going to just be on the company, okay? So your fixed selling expenses for the company are $385. That's right there. Your administrative is $130. That's right there. The total. Oh, forgot, negative sum. All right. Gives you that. And then you're only going to have to calculate whatever your product margin here is plus this. Okay? And that's part B. Anybody have any questions on that one? Okay. By the way, don't think these numbers are going to stay in there. I'm going to give you this, and that's it. So you have to go back in and redo these. And I want you to watch the video and try to recreate what I'm doing, including the formulas. That's a good way to learn the formulas. Okay? All right, so C. So for C, we're going to have this kind of header. Right. And C is asking us to, if the pastries line is dropped from the fixed baking expense, and fixed baking expenses don't change, what is the product margin for donuts and bread? Okay, so we're going to go in here and basically take this very same thing only we're going to just do donuts and bread. We're going to see what the total is for those two, right? So this is literally taking basically this entire thing right here, copying it down, copying this down, and doing a sum. Okay? So, and then making sure that you have these put in for your company part down here. So this is literally just a copy and paste right down here at this bottom part. That one is easy. I'm not going to go through it. Okay? So it's just basically pulling, what it's doing is it's analyzing, what happens when you pull pastries out of the mix. Okay? How does this net income change? And it does change. It actually reduces it significantly. Okay? So go ahead and go through and work that one. And then D says what other type of segmentation might be useful. And that's just an essay question you can answer down here at the bottom. So that one wasn't nearly as bad, was it? Long, but not hard. Okay, so I will give you the template to this. What I'm going to do is I'm going to delete all of these numbers and formulas. You can go back and watch, but I want you to put them in, okay? So, all right, so I will put this as a file for, let's see here, save as McKendree. This is going to be 7 template. Okay. All right. So there's that. We're going to do a new workbook. And I'm going to close this one out. Alright, so chapter 12. Chapter 12 is actually not too bad. This is just time value of money stuff. Okay? So, let me... Okay. So we're going to take a look at first E1220. Alright, so first things first, let me tell you a little bit. Jeanette says, I would love a file like that for the final. I'm sure everybody would, but use the homework. You can literally take and put in this exact thing in your homework from using your homework files, okay? And using the homework answer keys, okay? So just whatever the homework answer key looks like, that's what your problem should look like, okay? You should have virtually the same numbers. Labeling might be a little different, but there it is, you know? All right, so Chapter 12 talks about capital budgeting decisions. So basically what that means is it's looking at stuff like long-range planning and capital budgeting, budgeting models that do not consider time value of money, additional aspects of capital budgeting models that do consider time value of money, and evaluating capital budget models and taxes. Okay? So that's what this chapter is going to cover. It sounds like a lot, and it sounds like it's going to be extremely difficult, but it really is not as bad as it sounds. Okay? So let's get down to the problems. So, one thing to note. This appendix here, 12A, you're going to need that. There is on page 451 is the chart, this right here, that you're going to use to calculate some of these problems. So this is the present value of a dollar. Some of you may have already had this, like if you had a finance class or something like that. They also do this present value and future value and stuff like that in those classes. So you're going to get just a little taste of it, okay? So we're going to make this as easy as possible. So let's see here. All right. So in E1220, fairly simple to set up. Basically what you're going to do is, let's do this. Okay. Alright, so you're going to take the predicted cash flows, or cash inflows, or outflows. So this is a negative if it's an outflow, right? And then you're going to do the years, or years of cash flows. This is 12% a year as given by the problem, so you're getting the 12% present value factor off that chart that I just showed you, and present value of cash flows. Okay? So, present value of cash flows is actually pretty easy to get. So let's a little neater. All right, now. So this is going to be labeled A. This is going to be labeled B. This is going to be labeled C. And this is going to be A times C. Okay? Oops. How did I manage that? Oh, come on, really? Fine, I'm just going to label it C. So A, B, C. Alright. So, you've got your initial investment, which is given to you. Okay? You've got your operation. So, this is year 1, year 2, year 3. And then you have your net present value of all cash flows. This is extremely easy. So here's what you're going to do. So in this particular problem, it shows you that their initial investment was $82,850. Okay? And in year 1, they had an inflow of $30,000, year 2, $50,000, year 3, $40,000. Okay, there was no salvage value left at the end of this capital expenditure. Okay, so we're going to set this problem up to then calculate. So your initial investment is you sent money out, right? So this is going to be negative, right? Then they had an inflow of money from that initial investment of $30,000, $50,000, and $40,000. Oops. 40,000. Okay? So this is year 0 because this is when you purchased it. Okay? So there's no year calculation in that. You get down to here, you got 1, 2, and 3. Okay? Then you're going to go look up on the chart that I just showed you this present value factor. Now, in the initial year, it's always going to be 1 or 100%. So this is going to be 1.0. Okay? Then you just take your column A times this, and that's your answer for the present value of cash flows, right? Same thing goes with this. So let's go up and look at year 1's 12% present value factor times 1 for one year, okay? So I'm going to go back up to page 451. Okay. Now, this is present value of $1. This is where you're going to use this. Okay. You're not going to use this present value of an annuity. You use present value of $1. So, here's the period, Here's the percentage. Okay? This is the formula right here that you can use. If you didn't have a table like this, you could use this formula to figure out what your present value factor is. So these numbers right here. Okay? And all it is 1 divided by 1 plus the rate. So the 12% would be 0.12 to the number of years, power. Okay, so you could actually put this in the calculator and get this very answer that's on here. So for this one, this 12% in year 1 is 0.893. Does everybody understand how I got that? Okay, so we're going to put 0.893 right there. Okay, so then you take your 30,000 times your 0.893 and get your number. Okay, so you're going to go down through and you're going to do this for year 2 and 3, and then at the bottom you just sum all of these numbers together and get your answer. And that's your net present value of all cash flows. Okay? Alright, so that's A. Then we come down to B. And let's go back to the problems. We can look at that. Okay, determine the proposal's internal rate of return. So this one tells you you're going to refer to Appendix 12B if you use the table approach. Okay? So for the solution for this one, you're going to take and it's literally the same thing, the same chart that you had up at the top. So this, right? And whatever this number turns out to be, okay? And you're going to write out a small little blurb, okay? So basically, the investment proposal's internal rate of return is going to be what? That's what you're going to figure out, okay? So B is basically you saying the investment proposal's internal rate of return, it is what percent. Okay? That's all you got to do for B. Alright? So that is problem 12-20. Let's do 12-22. Okay? Oops. E12-22. Alright, so it's going to ask you to get your payback period, your proposal's internal rate of return, and your initial investment. Okay? So all of these are formulas. Okay? And it gives you your initial investment here. It gives you your net operating cash inflows for year 1, 2, 3, and 4. Okay? Then it tells you that what it's looking for here, the internal rate of return at 16%. Okay? So what you're going to do is you're going to come back up and you're going to use this. So there's another appendix that you have to use to get internal rate of return. Okay? And it explains to you exactly how to calculate all of these. Okay? So let's see. Where's 12? 2. Okay, so you're going to use the present value 1282 to get your the internal factor for the internal rate of return. Okay, so here we go. So on A, you're going to do the payback period. If I can type, period is going to be equal to, let's go back down to the problem so you can see this. So you've got $250,000 as your initial investment. So you've got to take your initial investment, so this is going to be equal to initial investment, which is $250,000, divided by your payback period, or the amounts that you're paying or you're getting back. Okay, this 100,000. So it's going to be 100 divided by the operating cash inflow year 1, right? So you would divide it by 100,000. Okay, and that's going to give you the number of years that it's going to take to get your money back. Okay, that's what a payback period is. How much time is it going to take me to get my money back on my initial investment? So if you think about that, in this case, 250 divided by 100,000, it's going to be 2.5 years, because I'm going to this plus half of this year gives me my initial investment back. That's what a payback period is. Okay. Jeanette asks, do we use the appendix 12B on that to get the percentage? Yes. Okay. You're using it to get your internal rate of return first and foremost, and then you use it to get the this percentage. Yes. So you use 12B to get that percentage as well. Okay. All right, then B, the factor for the internal rate of return. Okay, so once you get this payback period, which I've just told you is 2.5 years, you have to go back and for 4 periods, a factor of 2.5 corresponds time value of money at what? So you go back up to this appendix on page 152. Okay, and you're going to look for this present value amount of an annuity of $1. Okay, so 4 periods, at factor 2.5, and the closest one to 2, you're going to find the closest one to 2.5. So in this case, you've got to go across this line until you find something that is close to 2.5, which is the closest one. So it's going to be this. It would be your 22%. So there's your answer to B. But that's how you find it. Okay? So that's how you find your percent. And you're going to do the same thing for the first problem. Okay? All right, then your initial investment, so for B, you're going to payback period and number of years, which in this case is 4. Index 12. I'm going to put that note in there just so that you guys know what to look for. Alright, so then on C, you're going to take, this is the formula you'll use, okay, to get your annual, to get down to your annual net cash inflows, right? So you're going to do your initial investment equal to annual net cash inflows times factor for 4 years at 16%. Okay? So that's going to, then you have to work that problem. So this is kind of like an algebra problem, okay? You're going to fill in of this what you know, and you've got to try to work your way back, okay? So you know your initial investment is $250,000, right? And we know that our factor, we can look up whatever the factor is, okay? And that's going to give you, you're going to divide that, and that's going to give you your annual net cash inflows. Oops. It doesn't like it when you start things with equal signs in Excel. Okay? So that gives you your answer to C. And that is problem E12-20. Then we have problem 12-28. Okay? And the problem, part A, is a calculation. Okay? So basically it's going to go down through and it's going to ask you to do all of these various calculations. Okay, so let's take a look at this. You're going to have, let's take a look at the problem. Okay, so it says rank these investment proposals using the payback period, the accounting rate of return on initial investment, and the net present value criteria. Assume the organization's cost of capital is 12%. Round calculations to 4 decimal places. Okay? So, you've got 3 proposals here. Alright, so let's take a look at this. So what you're going to do, you're going to set it up like this. Proposal can I type A, B, C. Okay? And here's what you're going to figure out. So you need to say, okay, my payback period for each one of these tells you Proposal A, Proposal B, and Proposal C. Okay. Give me just a second, guys. I think that I may have found another problem with the answer key. Just lovely. Hmm. Okay. No, it's just me. Alright, so your payback period, you've got to figure out what that is for each one of these. It's going to be the same thing as what we did up here, okay? So you figure out your payback period first, right? And then you're going to figure out your accounting rate of return. Okay? So you got your total increase in income before depreciation. You got total depreciation. Okay. And your total increase in income. Life in years. Average annual increase in net income. Initial investments. And that's going to give you your accounting rate of return. Okay? Alright, so here we go. So you got to take a look at what they give you here in the problem. Okay? So your initial investment's $45,000, right? The cash inflow from operations, year 1, year 2, year 3. Alright? So how long is it going to take me to get my payback of that $45,000? Well, we can see it's going to take me 2 years. Okay? And then you do the same thing with B, same thing with C. So you figure out the payback period. I'll give you a hint. The first one's 2. Then you get your total increase in income before depreciation. Okay? So to get that, right, you've got to add up all of these numbers for each one of them. So for instance, this is proposal A is going to be 40,000 plus 5,000 plus 22,500. And that's going to give you your total increase in income. You're going to do the same thing for B, same thing for C. Then you get your total depreciation. Okay? And that is going to be 45,000 each year. Okay? Because we're taking advantage of being able to depreciate all of our investment up front. Okay? So 45 minus the 45,000, and that's going to give you your total increase in income, and that's not before depreciation, that's total increase in income. This should be off of there. Sorry about that. So you're going to do this plus this, and that gives you your answer. Now, it shows you here that there's a life in years, right? So that's this next one. So we've got 3 years. Okay? So you're going to then, the average annual increase in net income over the course of those 3 years, you're just taking this divided by that. Okay? And you're going to do that for each one of these. Your initial investment is $45,000. Okay? So to get your accounting rate of return, you're going to divide your average annual increase in net income divided by your initial investment, and it gives you your accounting rate of return. And you can come up here and decrease the number of zeros. That gives you the 4. Okay? So that's how you calculate those. That's the first part of it. Then you're going to come down and you're going to do the net present value at 12%. Okay? So you're going to take those factors. So you've got your year, and then you've got your factor. Okay, so you've got 1, and then you've got to find the factor at 12%. You got then you've got 2. Let's go do it again. And you've got 3. And again. And you've got your total. Okay, your initial investment. And you've got your net present value. Okay, so what you're going to do is you're going to calculate the present values. Okay, so for each one of these proposals, you're going to calculate a present value. Okay, so I'm going to values. Okay. So for each one of these, you're going to calculate that. So for instance, let's look up the factor for year 1. Okay, year 1 at 12%. We've got to go back up to our 12A appendix on page 451. Okay, so year 1 at 12% again is this 0.893. Everybody see how I got that? Okay. All right, so then what you're going to do is you're going to take your net present value and find the net present value of proposal A. Let me do this so it's not quite so confusing. Okay, so you're going to get your net present value of proposal A, your net present value of proposal B, and C for each one of these years. So you have to look up the factor. It's the same calculation that we did up here. Okay, and we're going to go back down to the problem so that you can see. Okay, so year 1, year 2, year 3 for proposal A, right? So basically what you're going to do then is you're going to come down here, okay, and you're going to take this year 1 for proposal A. It's going to be equal sign 40,000 times 0.0893, right? Did I not put? Didn't put enough zeros in that, did I? Didn't put too many zeros in it. There we go. I was wondering why that wasn't right. Okay, so 40,000 times the factor. You do the same thing for the 5,000. So you look up the factor for year 2, look up the factor for year 3, multiply year 2 by 5,000, multiply year 3 by 22.5. You come over, you do the same thing for proposal B and proposal C for these right here. Okay? Then you're going to just add those up. So just like that. Okay? You're going to then subtract your initial investment, and that's the same for each one. And that gives you your net present value by adding these two together. Now keep in mind this one's not right because we haven't filled in year 2 and 3. But you'll just, that's literally all you do. Okay? So then when it asks you to so then you're going to come in and rank it. Okay? And basically all that's doing is saying which one's going to give me the best rate of return. Okay? So for instance, on your payback, which you'll look at this, your payback period, you know, your proposal A, what the payback period is for that. Okay. Your accounting rate of return. And your net present value. Okay. So for proposal A, I'm just going to tell you what it is. This one is 2 to 3. No, don't do that. 2 to 3. Accounting rate of return is 1 to 2. And your net present value is 1. Okay. So basically what you're doing is you're coming through and you're saying which proposal has the best number in it. So you'll rank these. So like you'll rank proposal A, B, and C. So this one will either be 2 or 3. This one will either be 2 or 3. Okay, because you can't have 2 ones on this one. All right. If they tie, then that's where you come in with the 2 to 3 or the 1 to 2. Okay? So you're just ranking them. That's all you're doing. And then B, it asks you a question, which investment would you recommend, basically, and why, and explain the difference in the rankings. So that you're going to have to do. Just type it down here. Okay? So that is problem 12-28. And then we have 12-30. Just when we think we're done, right? Alright, so 12-30. P-30. Okay. So net present value with income taxes, straight line versus accelerated depreciation. Okay. Basically, you're going to read through this problem. Okay. And so you can read through it. Alright, so basically it's just saying for a typical $120,000 investment or equipment with a 5-year life and no salvage value, determine the present value of the advantage resulting from the use of double declining balance depreciation as opposed to straight line. Assume the income tax rate is 35% and the discount rate of 16%. Also assume that there will be a switch from double declining balance to straight line depreciation in the 4th year. Because why would we want to make this simple, right? So These are the types of things that we seriously deal with in corporate accounting. All right, so first thing we're going to figure is what the straight line depreciation would be. Okay, so straight line depreciation. All right, so you're going to get, first of all, your annual depreciation. They tell you it's $120,000. You're going to divide it by 5 years, which is the life, right? And that's going to give you this first number, okay? Then you're going to multiply that, so times the tax rate of 35%, and that's going to give you your annual depreciation shield, or tax shield. Okay? So whatever this number is times the tax rate of 35% is going to give you your annual depreciation tax shield. Then you do present value of an annuity of $1. So your number is going to equal 5 because that's how many years there are. And they tell you the rate is going to equal 16%, right? The discount rate. So you're going to look that up on your chart and get the present value of annuity rate. And that's going to go right here, the factor. Okay? You're going to then take present value of straight line tax shield. And all that is multiplying whatever this is times whatever your factor is. Okay? And it's going to give you your answer to that. Okay? Then you have to figure the double declining balance. Depreciation with a switch in year 4. Okay? So, here's how we're going to do this. You're going to take your depreciation base, the annual rate, the annual depreciation, the tax rate, that gives you the tax shield, the 16% present value factor, and that gives you your present value. Okay, so this is your 1, 2, 3, 4, 5. Okay? And you're going to calculate your depreciation base based on that. Okay? So here's how this works. Do you remember how to calculate depreciation from back in financial accounting? So we're going back a little bit. All right. All right, so basically what you're looking at is it tells you that you have a $120,000 investment with a 5-year life. So your depreciation base starts at $120,000, right? Your annual rate is going to be calculated like this. So if it's got a 5-year life with the straight line rate is 1/5 per year, the double declining balance rate has to be twice the straight line rate. Okay, so basically what it's saying is 5-year life, we're going to take 1/5 of that for each of the 5 years. If it's double declining, we take 2/5 of that until we get down to the remaining amount. So the annual rate is going to be 2/5. Okay? And then, come on, really? 2/5. Thank you. Okay, so our annual depreciation then is going to be equal sign 120 let's do this. 2 divided by 5. How did it get that? Let's just do that, shall we? Okay, so equal sign this times this. And that gives us our annual depreciation. Okay, so basically you can see how that compares, because up in the first part we said 120, our annual depreciation would be 120,000 divided by 5, which is 1/5, right? So if you do the math on that, it should be half of that. Okay, then we've got our tax rate. This is going to be the same for every single one. All right, so our tax rate is always 35%. All right, so that gives us our tax shield. Okay, so our tax shield then is going to be that 48,000 times the 35%. Okay. Our present value factor, we're going to look that up in the chart, and in this case, I'm not going to go back and look it up, but in this case, at 16% for the year 1, we know that our number is 0.862, and you can look that up in the chart. It'll be there. So then you take that tax shield times the present value factor, and there you go. So that's year 1. Now, given that, we have to then come down and figure out what our next depreciation base is. And if you remember from doing this in financial, you're going to basically take this minus what the balance is left over. Okay? So I took the 120 that we started with, and I subtracted out the previous year's depreciation. Now, again, we're going to do 2/5. Okay, so this is going to be equal sign 2 divided by 5. And we get that, and then we'll come down here and calculate that. And come down here and calculate that. Our present value factor here is going to be looked up. You find the present value, blah, 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 blah. And then the next one, same thing. You're going to take your 72, subtract out what you took into depreciation the previous year, and notice this is getting smaller and smaller. Okay? So when you get down to this one, okay, you're actually only going to take 1/2. All right? Because you're not going to be able to at one point. So this is going to be, I'm just going to put this in here, it's going to be 0.50. Okay? So this one will still be 0.40 because it's still 2/5. All right? This one's going to be half. Okay? And then this one is going to be whatever the balance is. Okay, what that means is whatever that number is right there on the screen, that's what it's going to be here, because there's not much left. Okay, so this should equal this, right? And then you just go through and you do the calculations all the way through, okay? And then at the very bottom here, you're going to have a sum of what all of this is, and that's going to be your total present value of the double declining value of double declining balance tax shield. Okay? So then, to get your advantage, you're going to take this, okay? So whatever this number winds up being, right? And the present value of straight line tax shield, which we figured out earlier. So this is going to equal whatever this is, and it's actually going to be the negative of that. Okay? So whatever the negative of that is, and then that's going to give you the advantage of double declining balance depreciation. So all you're going to do is add this one plus this one. Okay? And that's it. That is the last problem. All right? Does anybody have any questions? And no, I'm not going to leave the actual numbers in here. You got to fill them back in. Sorry. Make you rewatch the webinar. Okay? So I will save this to Module 8. So that you have it, and you guys can go back in and use it. Okay? Anybody else have any questions? Is there anything that I need to go over before we close up? Okay. Just remember, everything is open for you guys. It's all out there. Go ahead and take a look at it. The only thing that is not posted is Module 7 and 8 answer keys to the homework. Yes, this will be on YouTube. I will make sure that I put this on YouTube. So you will be able to go back and watch this. You can probably watch Module 7 a couple of times and, work the problems, not watch Module 8, and then when you get ready to do Module 8, just watch it from that point forward. Just make sure you note, where Module 7 stops, okay, so that you can kind of fast forward through it. All right? All right, so I'm sure everybody will be watching it a couple of times over. But once you do watch it and just kind of go through the problems and understand where the numbers are coming from and everything else, it'll get pretty easy. Okay. Once you get the answer key, it'll be even easier. All right. To prepare for your final, go ahead and make sure that you're starting to compare those problems to the problems that you already have. You might even want to start working on it so that you don't have so much to do all at once. Make sure you plan your time well. And again, I'm going to insist. I insist that everything be done in Excel going forward. Okay? I know there's a few people that wanted to do everything in Word, but you've got to make the conversion over to Excel. Have to. All right? You need to learn it. So hopefully by providing you with these templates, that will help as well. Okay? All right, guys. Drink a drink for us and have fun. I can do that. So I will definitely have fun, and I will stay connected and stay in touch. I just will not be able to answer questions except for Tuesday, Thursday, and then back on Sunday. So I will have some access on Saturday still, Friday and Saturday. But Saturday we board the ship by 1 o'clock. And so after 1 o'clock, you will not be able to get me on Saturday. It might be a little sooner than that, so don't take your chances. If you've got a question or something, give me an email, a text, a call, or something. See if I'm available. If not, because I will turn my phone off while I'm on board that ship. Otherwise, I'll get $4 a minute charges. So, I'm sorry, I'm not incurring that kind of expense. But yes, I will have fun. All right. Let me know if you need anything. I am here, and we'll get through it. If there's any catastrophes or emergencies, don't worry. We'll work through it. We'll work through it together, and we'll get it done. No problem. It is my pleasure. You guys have a great week. Keep up the good work. Everybody's doing a great job, and I'm looking forward to seeing lots of A's and B's this semester. So hopefully mostly A's. All right? All right, guys. I'm going to stop this and get it posted for you. Thanks. Talk to you later.